Most nurses have access to a secret weapon in the tax code, and many aren't using it correctly. It is called a health savings account, and it is the only account in America that gives you 3 tax benefits at the very same time. But here is the thing. Most CRNAs and nurse practitioners treat their HSA like a checking account for medical bills. They put money in, they take money out, they get the deduction, and they move on. But what if I told you that you could grow your HSA tax-free and invest it for retirement? Well, today I am going to show you just how to do it. This is MoneyRx for CRNAs and nurse practitioners. I am Brett Fellows with Oak Capital Advisors. And today we are talking HSAs. So let me tell you about 2 CRNAs, same age and same income, same hospital system. We will call them Lisa and Kevin. Both of them have access to a high deductible health plan at work. Both of them choose it to save money on their premiums. And both of them opened an HSA. But here's where they split. Lisa uses her HSA exactly like she uses her FSA. She contributes $3,000 a year, she pays her medical bills from it, and her balance stays near zero. Meanwhile, Kevin contributes the maximum amount every year. He pays his medical bills out of pocket, and every dollar in the HSA gets invested in low-cost index funds. He also keeps every receipt in a folder. Now, after 20 years, Lisa has maybe $2,000 sitting in her HSA, while Kevin has $340,000. Again, same income, same plan, different strategy, massive difference. So that is what we are unpacking today. But first, let us get clear on what an HSA actually is. An HSA is a health savings account. It is a tax-advantaged account that you can open if you are enrolled in a high deductible health plan. Now that last part is key. You must be enrolled in a high deductible health plan to contribute to an HSA. If you are on a traditional PPO plan, you are not eligible. And for 2026, the IRS defines a high deductible health plan as a minimum deductible amount of $1,650 for individuals or $3,300 for a family, and an out-of-pocket maximum of $8,300 for individuals and $16,600 for families. Many hospital and employer plans now offer high deductible health plans, so the first step is checking your benefits portal to see if you have that option. And for 2026, the HSA contribution limits are $4,400 for self-only coverage, $8,750 for family coverage, and if you are age 55 or older, you also get an extra $1,000 catch-up contribution on top of those limits. So a 55-year-old CRNA with family medical coverage could put $9,750 into their HSA this year. Tax deductible on the way in. Now, here is something to keep in mind. If you are a W-2 employee and your contributions go through your payroll, you also skip FICA taxes. So that's an extra 7.65% savings that you do not get with a traditional or 401k contribution. So for someone earning $200,000, that FICA savings alone adds up. Now, the triple tax advantage. This is the part I get excited about. The HSA is the only account in the US tax code with 3 tax benefits at the very same time. Tax benefit number 1 is tax deductible contributions. When you put money into your HSA, it comes out of your taxable income. So if you are in the 24% federal bracket and you max out your family HSA at $8,750, Well, you just cut your federal tax bill by $2,100 this year. Tax benefit number 2, tax-free growth. Every dollar inside your HSA can be invested, and that growth is completely tax-free. There are no capital gains, no dividend taxes, nothing. So it grows just like a Roth, but with the added benefit of the upfront deduction. Tax benefit number 3, tax-free withdrawals. So when you use the money for qualified medical expenses, it comes out tax-free. That means you got a deduction going in, you grew it tax-free, and it comes out tax-free, otherwise known as triple tax-free. Now compare that to a traditional 401k contribution. You get the deduction on the way in, but you pay taxes on every dollar you take out. So that so-called deduction is really nothing more than a temporary loan. Or compare it to a Roth. With the Roth, you get tax-free growth and withdrawals, but no deduction up front. So the HSA beats both of them for medical expenses. Now, a lot of nurses confuse the HSA with an FSA, so let me clear this up. An FSA is a flexible spending account. You get a tax deduction and the money can be used for medical expenses. But here's the problem. Most FSA money expires at the end of the year, so you use it or lose it. Now, the HSA has no expiration. So money you put in at age 40 is still there at age 65. Like I said, you can invest it, it grows, it compounds on itself, and there is no deadline to spend it. And the HSA also rolls over from job to job. You own it. It is not tied to your employer. If you leave a hospital and start a 1099 anesthesia job, well, your HSA goes with you. So here's the move that separates Kevin from Lisa. Kevin invests his HSA. He does not spend it. So most HSA accounts will let you invest it once your balance reaches $1,000 or $2,000. And then after that, every dollar above that amount can go into mutual funds or ETFs. So at $8,750 per year with, let's say, a 7% average return, an HSA grows to over $340,000 in 30 years, tax-free the whole way. Now you might be thinking, okay, great, but what if I have a big medical expense? Well, this is where the shoebox strategy comes in. So let me introduce you to the shoebox receipt strategy. This is actually one of the most underused tax strategies that I have seen. Here's how it works. When you have a qualified medical expense now, you pay it out of pocket, not from your HSA. You save the receipt. There is no time limit on when you can reimburse yourself from your HSA. You can have a $3,000 medical bill in 2026, pay it out of pocket, and reimburse yourself in the year 2035, all tax-free. So what happens in the interim? Well, you let the money stay invested and growing for years. And then when you need tax-free cash in retirement, you just pull out your old receipts and reimburse yourself. So let's say Kevin has been doing this for 12 years. He has $47,000 in documented receipts. Anytime he wants, he can take $47,000 out of his HSA tax-free. No taxes, no penalty. So keep your receipts, every single one. The IRS just requires that the expense was incurred after the HSA was opened, and of course, that it was a qualified medical expense. Now, a word of warning about Medicare timing. So this is one of the major mistakes I see CRNAs and nurse practitioners make as they approach retirement. So they keep contributing to their HSA right up until they start Medicare. And they then get hit with a penalty that they, of course, did not see coming. So here is the rule. You cannot contribute to an HSA once you are enrolled in Medicare, any part of it, Part A, Part B, either one. And most people know that. That makes sense. But what most people miss is the look-back rule. So when you enroll in Medicare, your coverage can be backdated up to 6 months. So that means if you sign up for Medicare at age 65 and worked until age 65, you may owe a 6% excise tax on contributions made in those last 6 months. Now the fix, of course, is simple. Stop contributing to your HSA at least 6 months before you plan to start Medicare. Mark it on your calendar or tell your advisor. This is a $500 to $2,000 mistake that is completely avoidable. And here's one more thing that most people do not know. After age 65, your HSA works like a traditional IRA for non-medical expenses. So you can take money out for anything. Yes, you will pay ordinary income tax on it, just like, say, a 401k or an IRA, but there's no penalty. So worst case, your HSA turns into a traditional IRA at age 65, and best case is you use it all for medical expenses, and every dollar is completely tax-free. So healthcare in retirement costs the average couple over $300,000 over their lifetime. By having a dedicated tax-free account for those costs is not just smart, it's really essential. So here's your action plan from today. Step 1, check your benefits. Do you have access to a high deductible health plan? Step 2, if yes, well then consider switching to it during the next open enrollment. If so, step 3, open an HSA and contribute the maximum. Step 4, invest the balance once you hit the threshold of a few $1,000s. And step 5, save every medical receipt, every single one. And finally, step 6, if you are over age 50, add that extra $1,000 catch-up contribution. So the HSA is not complicated, but it is widely underused by nurses who could benefit from it most. If you want to see how an HSA fits into your full retirement plan, feel free to go to oakcapitaladvisor.com and schedule a call with our team. We work specifically with CRNAs and NPs. We understand your income, your schedule, and your goals. If this episode was helpful, share it with a colleague. Leave us a review on Apple Podcast or Spotify, and we will see you next week.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.